Okay. All right. I don't see any questions, chat, so I'm going to jump right in and start telling stories. The story that I want to tell starts at Enron. I don't know if you guys know much about Enron. If you do, chat in, tell me what you know about Enron. You might, okay. All right. I don't see any questions, chat, so I'm going to jump right in and start telling stories. The story that I want to tell starts at Enron. I don't know if you guys know much about Enron. If you do, chat in, tell me what you know about Enron. You might be Googling the Enron. If you Google Enron, the first thing you're going to see is Enron scandal. So if you, I purchased a website domain this week for this story. I'm going to build a page on our website. It's called enronstory.com. Because ironically, I had some clients, I still do, who actually worked at Enron and they invested at Enron. So I'm going to tell you the story of Enron because it's a very interesting story and it's packed with very helpful information for anybody who wants to be an investor, for anybody who wants to become wealthy, for anybody who wants to make wise choices with their money. The Enron story is packed and loaded with wisdom and mistakes. And so I'm going to tell some stories. Brother's father-in-law worked for them at the time of the scandal. Bad, bad, bad. Yeah, so Benjamin, that's kind of, I'm going to tell you a story about a guy named Bill. Bill was a company man. I call him Bill the company man. And then there's Joe. Joe was very entrepreneurial, so I call him Joe the entrepreneur. One of the businesses that Joe invested in was a farm. So I'm going to tell you the story about Joe the farmer and how he bought cows. I'm going to use Joe's story to teach you about dollar cost averaging. Bill's story, Bill the company man, is not so pretty, and I'll tell you Bill's story first. But then there's Andrea Smart. That's not really any of their names. I changed all their names to protect the innocent. But so there's Bill, the company man, Joe, the entrepreneur, and Andrea Smart. Andrea, by the way, was just this really smart person. I consider her one of the smartest investors I've ever worked with. I love working with people who are not clueless. Now, I'm happy to work with people who are clueless. And when I say clueless, I don't mean to be mean, but the truth is not everybody cares about investing strategies and principles of investing and, you know, the risk metrics and all of the things that go into successful investing. Not everybody cares. And I get that, and that's great. I'm happy to work with people who don't even want to know. They just need somebody who does know, who they can trust. And Andrea wasn't one of those people. Andrea was one of those people who wanted to do her own research and be well informed. And then she would hire a guy like me to kind of get a second opinion, which is what she did. But her, you know, my second opinion was, Andrea, you're doing a great job. Keep doing what you're doing. And so I'm going to tell you her story along the way. It's in the Enron story. But let's start with Bill. Bill, the company man. So Bill, he was the perfect company man. Bill was the guy, like probably your uncle, maybe your Enron is the reason I have a job. Yeah, that's an accounting partner for you. That's true. A lot of attorneys could say the same thing. Enron and companies like Enron are the reason we have regulators. So back to Bill's story. Bill, the company man. Bill was your typical kind of CEO guy. He was a, you know, a department head. He was pretty high up in Enron. Not high up. He was really a middle manager, but he made good money. Any of us would look at his job and say, he's really done a great job for himself. And he did. He worked hard. He was there a long time. He was the perfect company man. And when I say the perfect company man, he was loyal to the company. He believed everything the leaders at Enron told him. He didn't question anything, really. And so when I got to know Bill, my first advice to Bill was, Bill, think about it. You have way too much Enron stock. Not only do you have too much Enron stock because you're putting all of your 401k in Enron, because his 401k, he got matched, and the company stock kept going up and up and up. And he was like, I'm getting rich. And he was getting rich. He had over $1 million in his 401k. Bill, the company man, just kept doing what the leaders said. There's never been a better time to invest in Enron. That's what they told him. All the way up until the end, when they knew, the leaders, some of them went to jail, they knew they were playing a game with the numbers, and they knew that it was all about to collapse like a house of cards. They told Bill and the rest of the employees at Enron, there's never been a better time to invest in Enron. So what did Bill do? He doubled down. He put everything he could into his 401k. And the problem was, I said, Bill, look, the problem is you have all this investment in Enron, but that's also where you work. That's where you earn your income. So you're double dipping. You're totally not diversified, and that's dangerous. It's when it comes to an investment strategy that can help you maximize returns and minimize risk, it may seem like investing in Enron is a great strategy, or even Apple or Amazon, but you never want to invest in one thing. And that's exactly what Bill did. And you know the rest of the story about Enron, but what you don't know, Bill and his wife, Eleanor, they had a really good retirement package lined up. But the problem was that retirement package was all counting on Enron. And Enron collapsed like a house of cards. And when that happened, Bill got very anxious. He was only a couple years from retirement. So he was an older gentleman. And he got so anxious and full of fear and anxiety. What is he going to do? He had no job. He had no money. His 401k turned into zero pretty much. Not zero, but really close to it. And Bill died of a heart attack. Anxiety ate him up, and regret, I think, and he died. And Eleanor hadn't really worked. She was the widow. And Eleanor's story, she worked with my wife as a teacher's aide, and you don't make much money as a teacher's aide or a Walmart greeter. And it's not to say those jobs aren't meaningful and helpful, but they're certainly not something that can give you a retirement with dignity. And that's what happened to Eleanor. And that's really, I think, the sad story of Enron that's been told over and over with I don't even know how many investors. So the Enron investor story for me starts with Bill, the company man. And it illustrates, number one, the most important investment strategy of all, which is diversification. It's the simplest, easiest, most basic strategy. But if you want to maximize your return and minimize your risk, you need to understand diversification. It's so simple, it's pretty much scary. I mean, you just don't want to invest too much in any one thing, and you certainly don't want to invest everything in only one thing, which is what Bill did. And he paid for it, and his widow and his family paid for it. So that's the first investment strategy, diversification. Second is asset allocation. Third is dollar cost averaging. And fourth is portfolio rebalancing. So let's talk about asset allocation. Asset allocation is, it's proven, studies have been done, that asset allocation is the single most important determinant of your portfolio's returns. So, if you Google asset allocation, or if you Google diversification, what you're going to find is a whole lot of people write about diversification and asset allocation in the same sentence, in the same article, in the same context, but they're really two different things. One is very simple, straightforward. It's just not putting all your eggs in one basket. It's diversifying. But asset allocation, which today most people, when they say diversification, they're talking about asset allocation. But it requires that you understand a few things about asset classes. So I'm just going to name off a few asset classes, because for you to understand the power and the importance of asset allocation in terms of an investment strategy, you really need to understand what is an asset class. So if we were in person in class, I would just start asking questions. We'd start having conversation, and we would, sorry, I saw a chat. I thought it was a question. So if we were in person, I would start asking questions, and I would find out what you know about asset allocation. So I'm going to ask you to, if you know a little bit about asset allocation or asset classes, just tell me what you know in the chat box. I'm going to start naming off some asset classes, and I'm going to describe them a little bit and try to help you understand how they work together over time in terms of a portfolio. So the first asset class I think of is large cap. Anybody know what large cap is? And then if you think large cap, the next thing you would think is, okay, what's the opposite of large cap? Small cap. And then what's in the middle? Mid cap. So does anybody have a clue what large, small, mid, what those asset classes might look like? So I'll come back to that. But that's equity investing asset classes. And you could invest in an individual stock like Apple, or you could invest in an index like, you could invest in a mutual fund, an index fund, or an ETF. Those are types of investments. They're not actual, well, they're types of investments, but mutual funds, there's a whole bunch of different kinds of mutual funds. And they could all be different, investing in different asset classes. So you can invest in a mutual fund that's focus is large cap stocks. Or you could invest in an index fund, which focuses the S&P 500 or the Dow or the NASDAQ. So you can invest in a mutual fund and get diversification that way by paying a manager to pick stocks in any asset class. Or you can invest in an index fund where you're just buying an investment that replicates or acts like a proxy for an index, like the S&P 500. I keep mentioning the S&P 500, and I suspect some of you don't know what the S&P 500 is because nobody's posted a comment in the chat. So I better take a minute and start with the S&P 500. So the S&P 500 is the Standard & Poor's 500. It's the 500 largest U.S. companies on the planet. So if you invested in something that was a proxy or replicated the performance of the S&P 500, you would be investing in a fund, mutual fund, an index fund, or an ETF, exchange traded fund. You could be investing in that whole list of companies with one investment in one asset class. Does that make sense? So that's like the basic building block of asset allocation. Thank you, Monica. I'm glad that makes sense. So the S&P 500 are the large companies. Think of the largest companies. Like right now, the S&P 500, 40% of the value of the S&P 500 comes from 5 stocks. Microsoft, Apple, Amazon, Google, and Netflix, I believe. Maybe Facebook too, so maybe 6 stocks. But think about that. With 500 companies and the stock market's huge rise since COVID hit is based on only 6 companies. 40% of the value of that index is based on just 6 companies. That scares me because when you talk about asset allocation and diversification, you're starting to see something here that hopefully you understand is a little bit risky. Yes, the S&P 500, if you look at a chart, and I'll post you some charts and some videos that I'll work on. In fact, I might post charts when I do this. When I post this video, I might overlay it with some charts, but I'm not going to do that while I'm telling the stories. But the S&P 500, it goes up, 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 and then it comes down, down. And if you look at that chart, and I'll show you that chart. In fact, I'll pretend that chart's right up there, and you'll see it. I'll share it. But it's a chart, and it goes up and down. And that's okay, because I'm going to teach you how to use these strategies to make money over your lifetime. But you need to understand that large cap stocks right now, they've just gone up, 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 up. And they're very likely to go down, 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 and then back up, up, up. And over time, they go up. Over time, equities go up. Large cap is large companies. Small cap is small companies. Which companies do you think have more risk? Large established companies or small startup companies? Which one has more risk? Small. I see some people saying, why do you say smallies? Why small? Why? It's not a difficult trick question. It's very simple. Small companies are risky. A lot of small companies go out of business. And yeah, they go public. You can trade their stock, but they may start out as a penny stock or a dollar or whatever. They're just small companies and they have a lot of risk. So because they probably can't borrow as much or aren't as diversified. That's exactly right. Now, that's inside baseball right there. But the truth is, small companies don't have access to capital like big companies, big established companies. That's one reason that I'm not going to get into macroeconomics here, but if you don't know what a zombie company is, just for your own benefit, you might want to know what that is. It has to do with capital and debt. So we talk about stock and equity asset classes, large cap, small cap, mid cap, it's right in the middle. Less risky than a small cap, more risky than a large cap, but it's an asset class. And then on the other side of that, on the opposite side of equities, you have bonds. And I posted some videos and some content to help you understand the difference between an equity and a bond. And I'm not going to go into that except to say that they're two different asset classes. And typically when one goes up, the other one goes down, which is one of the things that's really helpful about asset allocation. When you do it right, one asset class goes up and the other one goes down, and they generally are not correlated. Now, none of them are perfectly correlated or perfectly uncorrelated, but that's part of the magic, if you will, of asset allocation in terms of a risk management strategy and a strategy to maximize returns. It's really important. Asset allocation is all about asset classes. So you've got large cap, small cap, mid cap. You got bonds, and you got government bonds, you got corporate bonds, two different asset classes under the same category called bonds. And if you don't know the difference between a bond and an equity, it's because you didn't do your homework. You didn't watch the video and understand, and you need to go back and do that because it won't make sense to you and it won't give you the insight that you need to be like Andrea Smart, the smartest investor. She understood, and so she did a great job of allocating assets across different asset classes in all of her investments, in all of her accounts, in a way that made her outcome really, really good. And I'm going to tell you more stories about Andrea Smart because she kind of set the table for me early in my career as like the paradigm for, man, I want to invest like her. I want to teach other people to invest like her. She was really smart, still is, very successful. So asset allocation is key. So you got bonds, you got corporate bonds, you got municipal bonds, you got government bonds. Those are all different asset classes with they do different things. And this course and this lesson, this story isn't to teach you all the ins and outs of an asset class, but it is to help you understand that this one investment strategy called asset allocation, it's critical to understand that it's all about asset classes, mixing them and configuring them in a way that gives your portfolio the best chances to perform well and to manage risk. So you got equities, you got stocks, you got bonds. Stocks, large, small, mid, bonds, government, corporate, municipal. But then you have a whole nother branch, which is international or emerging markets. So you could invest in Japan, you could invest in Europe, you could invest in Russia. Those would all be a whole nother class. That could be an emerging market with a large company, emerging market with small company, emerging market with a micro company. I mean, there's all kinds of asset classes. And I'm not saying you should be investing in every asset class because you can't, you wouldn't want to. But you should be diversifying and spreading out and allocating your asset classes depending on how much wealth you have to invest. You want to, spread it out in a strategic way That's called asset allocation. And there is no more important strategy for you to understand the basics of than asset allocation, because it's the number one determinant of your portfolio's returns. So here's the bottom line. We go back to the perfect investment. Day number one, you're asked, you got your perfect job. Let's pretend you're making $100,000 to keep the math simple, and you get an 8% match. How much does that mean you have to put into your 401k in order to receive that perfect investment opportunity? 8% of 100,000, remember, it's $8,000, which means if you're getting an 8% match, you have to commit to put 8,000 of your salary into your 401k, which means day one, when you're sitting down with HR and they give you the form, you say, yes, I want to participate in the 401k. How much do you want to participate? You're going to do a little math and you're going to figure out, if you get paid twice a month, how much is that to be deducted from your paycheck to go into that account? How much should that be to equal $8,000 in a year? Simple math. You're going to make that calculation. You're going to put that number down because you want to at least commit to the $8,000 a year. If you're getting an 8% match and you're making $100,000 a year, that's $8,000. That's what you want to invest. You could do more, but absolutely don't leave that on the table. Don't leave the match on the table, because you put $8,000 in. Number one, you put $8,000 in. Number two, they put $8,000 in your account. So you just doubled your investment. There's no better investment. It's the perfect investment. If you have the opportunity, number one, you put the match in, the total amount. Number two, they match it. And number three, another three reasons. Well, the third thing I want you to know about the perfect investment is, if you make $100,000 and you put $8,000 into your 401k, then you basically get an $8,000 tax deduction, which means the IRS looks at your tax return and they say, instead of you making $100,000, you only made $92,000, which means you only pay tax on $92,000. So the tax deferred, tax deductible benefit of your 401k is tremendous. And now you get to the next question on that form. It's like, okay, you're going to put $8,000 a year in and we're going to match it. Where do you want to invest that money? And before you took this course, about half of you would have said, I want to invest it in my 401k, or I want to invest it in my Roth IRA, or I want to invest it in my IRA. But those are not, or my brokerage account. Those are types of accounts. They're not investments. So now on that form, you have to look at what your options are, and what you're going to see is going to be really cool. You're going to be like, oh, I remember now. Professor Munchback was talking about this. You're going to say, I want to put some in large cap, small cap, international, and bonds. And maybe that's the only four options you get, is large cap, small cap, bonds, international. And that'd be okay. You could do 25% in each and you'd be just fine. You don't have to get it perfect. Some of you are going to be smart enough to know how to allocate that a little differently. And you may have way more options than just four. But that's the basics of asset allocation, and you need to understand it well enough so that day one, when you're sitting down with HR, you can take advantage of the perfect investment in a way that's going to make your money do a lot better for you than if you just put it in the money market. That's like putting it in your checking account. And some of you did that with your $1 million, and you're going to fix that for your capstone assignment, because you're going to see how that moves the needle to do proper asset allocation instead of just putting it in your checking account. It's going to move the needle for you tremendously. And if you learn that and understand that, and you apply the basic lesson of asset allocation to your portfolio over your investing life, I'm telling you, it's going to make a huge difference in the outcome. It's going to make it super easy for you to become a millionaire by the time you're 50, or maybe a lot sooner. Okay, let's see. All right, so we've covered 2 of the 4 investment strategies that are designed to maximize return and minimize risk. First one is diversification. The second one's asset allocation. The third one is dollar cost averaging. And the fourth one is portfolio rebalancing. So I told you about Bill, the company man who passed, went through tremendous anxiety because he really, truly, I mean, there's no question in my mind that his death and his shortened life was a result of bad financial choices. He failed to diversify and he went down with Enron. Terrible tragedy. Unfortunate for his widow. She survives, but barely. And I mean, barely financially. So that's the first story, diversification. The second is asset allocation. And it's really a story about different types of asset classes. And every wise investor knows about asset allocation, and you need to as well. It's easy to find more information on it. So I would encourage you to just get familiar with it, put it on your radar, pay attention to it. The third investment strategy that is designed to maximize your return and minimize your risk is really my favorite strategy. It's called dollar cost averaging. And so we're going to go back to Joe, the entrepreneur, and we're going to basically take a look at his approach to investing. Now, Joe was one of those guys who was in leadership at Enron, and he had an opportunity early on to cash out, basically. He had stock options. He owned a good portion. He owned a percentage of Enron, and a very small percentage, but in his world, that was a tremendous windfall. Great. It reminds me of a story. I'm going to tell you another story. It's not about Bill. It's not about Joe, the entrepreneur. It's about a guy I grew up with his name, Irvin is his name, but we called him Magic Johnson. I went to high school with Magic Johnson. I met him when I was in like the 6th grade. My friend Kirk, I hope I didn't already tell you this story, but my friend Kirk had really big hands. Kirk still has big hands, but he actually, you ever see somebody snatch pennies off their elbow? He had the Guinness World Book record. 52 pennies he snatched off of it. This is weird, I know, but it's probably way more than that today. But Kirk said to me, we're on our bicycles, it's June, it's summertime, and he said, hey man, you think I have big hands? I was telling him, man, you got the biggest hands I've ever seen. They're crazy and weird. It's like, you want to see big hands? Let me introduce you to my friend Magic. I'm like, Magic? It's like they call him Magic because he's magic with a basketball. So Magic at the time was in 7th grade or 8th grade. But my friend Kirk and I would get on our bicycles and we ride over to Everett High School, and the gymnasium is open even though it's summer. There's one person in the gym shooting free throws. And my friend Kirk walked up to him and said, hey Magic, I want you to meet my friend Jim. And that's when I met Magic Johnson. And I went away from there thinking, why would anybody want to be in a hot, humid, muggy basketball court on a summer day when there's so much else to do? As we rode our bicycles to the lake and had fun and goofed off, Magic Johnson was practicing free throws. And that kind of tells the story. It's part of the story of Magic Johnson. I read a story about him not long ago. Magic Johnson had one investment that he regretted, maybe more, but one that he talked about in this story. And that was he invested when he was when he was with LA and he was famous. He got through Michigan State. We watched him win the championship, beat Larry Bird. He was a young kid, really, but he was a professional athlete, and so he was getting all these deals. And Converse tennis shoes offered him a deal to do an ad, a commercial for their tennis shoes, to be their spokesman, and he took it. They paid him money, and he liked it. It was a good deal of money, and he was thrilled. But Nike also offered him a deal. Nike was a brand new company at the time, and Nike offered him stock. He said, we will give you stock in our company to be the face of our brand, of our product. And Magic turned him down. He's like, no, I'll take the money in hand instead of the stock ownership. And this story relates to Joe, the entrepreneur, because if Magic will tell you, he's worth $600 million today. So he did a lot of things right from an investment perspective, but he could have doubled his, maybe more than that. I mean, he would have been a billionaire for sure if he would have taken stock in Nike. But he didn't do it. That's one of the things he regrets. Well, again, back to this story of Joe, the entrepreneur. He took the stock and he cashed it out at just the right time and created a tremendous net worth for himself. And one of the things he did with that net worth is he went and bought a farm. And Joe, when he bought the farm, I was his advisor, and he had a lot of deals going on, but the farm was very near and dear to his heart. And he had pigs, he had horses, he had chickens, he had crops, he had a lot of things, but he didn't have cows. And so he came to me one day and he said, I want to invest in cows. I think it'd be good to diversify. So I asked him some questions like, what are you going to do with the cows? How are you going to market? How are you going to buy? How are you going to sell? What are you going to do with the cows? So it was steaks, it was leather goods, it was breeding, it was, rodeo stuff, because Houston rodeos, a lot of moving parts. He always had this vision that was crazy, but he starts buying cows. He says, I want to buy cows. I'm like, okay, let's put together a strategy. How much are we going to invest in cows? And to keep the story simple, I'm going to say cows were $100 a head. Now, this story about Joe the entrepreneur, Joe the farmer, Joe the cow farmer, it's about dollar cost averaging. So pay attention. This is the story of Joe and cows. So Joe says, I'm going to invest in cows. Dollar cost averaging is a systematic approach to investing where you pick a number and you say, I'm going to invest this much every month, just like you'll do in your 401k. That's what Joe did with cows. He said, I'm going to invest $100 a month in cows. And it just so happens that cows were selling, guess what? $100 a head. So month number one, Joe buys one cow. Now month number two comes along, and guess what happens to the price of cows? It drops to $50 a head. So Joe's commitment, his dollar cost averaging systematic investing plan, says he's going to invest $100 a month. But how much are the cows selling for this month? Not $100 a head, but $50 a head. So this month, month two, Joe gets to buy two cows for the same $100. Pretty cool, huh? But then the next month, month number three, Joe, sticking with his plan, investing $100 a month, dollar cost averaging, systematic investing, puts his $100 into cows, except this month, month three, cows drop all the way down to, guess what? $25 a head. How many cows does Joe get? Month number three, Joe gets 3 cows. And then month number 4 comes along. Now, month number 4, Joe sticks with his plan. He's getting a little nervous, though, but he sticks with his plan. Actually, he didn't really stick with his plan. He picked up the phone and he called me and he said, Munchback, dude, I think we made a mistake. You got me buying cows at $100 a month, and they went from $100 a head down to this month, month number 4, they're $20 a head. He's like, I want to get out of the cow business. This is crazy. I'm like, wait, Joe, time out. Wait, Joe, listen, trust me. This is why you pay me the big bucks, to listen to my advice at times like this. So I said, Joe, look, you got into this business, the cow business, because you needed cows. You needed what you can do with the meat, what you can do at the rodeo, what you can do with the hides, the leather goods, all that. Those things haven't changed. The only thing that changed is cows are now $20 a head instead of $100, and you want to bail? I'm like, dude, you need to sell your John Deere tractors and go buy a whole lot more cows right now. Joe's like, huh. He thought about it. And he said, okay, look, I'm going to stick with the plan. I'm not selling the tractor, but I'm sticking with the plan. So month number 4, Joe bought 5 cows. So month number 1, they were $100. Month number 2, they were $50. Month number 3, they were $25. Month number 4, they're $20. If you're taking notes, I'll send you, when I do this video, I'll put an image up. When I post this video, and it'll show a chart like a bell curve with pictures of cows. You'll see it. So there it is. You're not seeing it now, but you'll see it when you see the video on YouTube. So Joe basically sticks with the plan. Follow the story. Month number 1, $100 ahead. Month number 2, $50 ahead. Month number 3, they're $25 ahead. He can buy 3. Month number 4, they drop all the way to $20. He buys 4 or 5 heads of cattle on month number 4. And then the next month, they start to do the opposite. They go back up. So month number 5, the cows are going back up from $20 ahead to $25 ahead. How many cows does he buy in month number 5? If he sticks with his plan, his dollar cost averaging, his systematic investment of $100 a month in cows, he's buying cows, and now the cows are $25 ahead. How many does he get? He gets 4. Right? $100, 4 head, $25 ahead, 4, that's $100. The next month, they go back up to $50. Joe sticks with his plan, his strategy, dollar cost averaging, systematic investing, $100 a month, investing in cows, his asset class, right? This is cows. It's like an asset class, just like, a large cap stock, small caps, remember, right? Think about it that way. But this is cows instead of chickens or pigs or corn or soybeans. It's cows. Systematic investing plan, dollar cost averaging, $100 a month. And now it's, where are we? Back to month number. We went through month 1, $100, 2, $50, 3, $25, month number 4, $20, month number 5, $25, month number 6, they're back to $50 ahead. He buys 2. The next month, cows get all the way back up to $100 ahead. That's when I called Joe. And I said, Joe, look, I'm your investment guy. I give you advice. And you called me a few months ago. You were freaking out. Remember? Yeah, I remember. Yeah, okay. Well, this month I'm calling you, and I'm telling you it's time to sell some cows. And we'll buy some more cows later, but right now we're going to take our profits. Not all of them, but we're going to sell some. So let's do the math. Somebody grab a calculator and help me. Yolani, I'll answer that question soon. But somebody help me do the math. So month number 1, $100 ahead, 1 cow. Month number 2, $50 ahead, 2 cows. Month number 3, $25, 4 cows. Month number 4, $20 ahead, 5 cows. So 100, 50, 25, and 20. And then we go to the next month, month number 5, they're back up to 25. Month number 6, they're 50. Month number 7, they're back to 100. So 7 months of investing. How many cows did Joe buy in 7 months? If you're listening, if you're paying attention, now's the time to show me that you deserve all 200 points of class participation. This is it. I'll wait. Yep, that's right, Brian. Yep, Apollo, that's right. So that's good. I got 2 takers. I will remember you. So 19, over 7 months, Joe bought 19 cows. Now, how much did Joe, and that's right, Hannah, how much over 7 months, this is not a trick question, but over 7 months with Joe's strategy, called dollar cost averaging, his systematic investment of $100 a month into cows. Over 7 months, how much did Joe invest in cows over 7 months at $100 a month? Not a trick question. So about 37 per cow. That's not the question, Brian. I mean, how much did he invest? Yes, $700. He invested $700, exactly. 7 months, $100 a month, $700. And how many cows did he buy? 19 cows. So now, how much are his cows worth at $100 a head? Somebody add a $sign and 2 zeros. Yep, Randy, you forgot the $sign. Camille, you guys are great, right on. But there should be a $sign there. Just there you go. A $sign. Thank you very much. $1,900. So think about it. This is how this strategy works. It works. It is a great strategy. Joe invested in cows. Cows went up and down. just like every other risky asset you're ever going to invest in. Large cap, small cap, even bonds go up and down. So the point is you have a systematic approach to investing, and over time, when the price is high, you get fewer shares. When the price is low, you get more shares. But over time, you maximize your return, and more importantly, you minimize your risk. Because what if Joe, think about this, what if his advisor would have said, hey, Joe, you need cows? Let's go buy cows. How much you got in your budget to buy cows? And Joe would say, okay, over the next year, I got $1,200 to invest in cows. But I'd be like, okay, well, let's do it this way. Let's do it a month by month basis. Let's dollar cost average. So we minimize our risk. And let me ask you this, did we maximize our return with the volatile price of cows in that scenario? Yeah, we managed our risk by not investing all of our money at the same time in cows when they were priced way up here. It's like today, everybody wants to know, should I buy gold? Maybe, but look at the price of gold today. Or look at silver, what it's done in the last few days. Now, I'm not saying it's not going to keep going up. I don't know. But I would say let's dollar cost average. If you got a long horizon, you don't want to take all of your savings and put it in one asset class because that's too risky. You want a dollar cost average and spread it out over other asset classes, cows, chickens, pigs, corn, soybeans, whatever. Does that make sense? Dollar cost averaging, in my opinion, is the most powerful investment strategy designed to maximize returns and minimize risk. It's my favorite strategy, and it's great for folks your age. Now, the next strategy is very simple, and I'm going to end with the fourth strategy, which is simply portfolio rebalancing. If you just draw a circle and think about your 401k, and let's pretend you have 4 asset classes: large cap, small cap, international, and bonds. So you got 4 asset classes, and draw a pie. You got 4 equal pieces of the pie. Over time, let's say the large cap did what the large cap did in the last few months. They just went off the charts. So now, a few months later, instead of having a balanced portfolio with 25% in each asset class, now your large cap is like 50% of your portfolio. It's not a quarter. It's not a piece of the pie, an even quarter of the pie now. It's much, much bigger. And international shrunk. It just went way down, like those cows. It just went way down. It's like month number 4 of cows, where it's $20 a head for cows. Now your international, your emerging market, those investments have dropped to so low. And you could be like Joe and you could say, I got to get out. I'm going to sell them all, put it all in the large cap. And that's a mistake. Portfolio rebalancing is like dollar cost averaging. It's a systematic way to rebalance your portfolio and take advantage of the highs and the lows in those asset classes, so that over time, it's like doing dollar cost averaging as you invest into your investments, and portfolio rebalancing as you take advantage of the movements within the investments that you've already made, that are already there growing, that are already allocated to those asset classes. As those asset classes swell and shrink, you just rebalance. And over time, that investment strategy is designed to maximize your returns, minimize your risk. Four investment strategies designed to help you maximize returns and minimize risk. Number 1 is diversification. Bill in the Enron Story didn't do it, and he paid for it. Number 2 is asset allocation, the number 1 most important determinant of your portfolio's return, asset allocation. Number 3, my favorite, the most powerful investment strategy designed to maximize returns and minimize risk, Farmer Joe and dollar cost averaging. And then finally, the 4th investment strategy designed to maximize returns and minimize risk, portfolio rebalancing. It's very simple. Sometimes you can set it and forget it. Do it every 6 months, once a year, once a quarter, probably don't want to do it more often than that, but it's a very easy to implement strategy in your 401k, your IRA, your Roth IRA. So those are the 4 strategies designed to maximize returns and minimize risk. And when I do this video and post it on YouTube, I'll put some images and helpful stuff so that you can kind of see it as I'm talking through it. But I hope that's helpful. It's time to close out. I'm a little bit over, so thanks for hanging out. And I'll post this on YouTube. Remember, go back and watch it again. Hit the fast forward button so you don't have to hear me talk real slow. But you want to remember these 4 investment strategies. They're going to be very helpful. And I'm not just talking about your capstone assignment. They will help you in the capstone assignment, but they're really going to help you in real life. And that's why they're 4 of my favorite stories and 4 of my favorite strategies. So thanks for watching. I'll see you next time. Have a great week.